Good evening. Good evening to all of you. So, give me a second. So, in last class, we have started our discussion about the monetary policy, and I have discussed about what is the structure of monetary policy committee, tenure, each and everything I have discussed. Then I told you about types of monetary policy means it can be expansionist or it can be contractionist, right? And for that, they use the tools, right? The monetary policy tools. There are quantitative tools and qualitative tools, right? And qualitative tools, they are used for certain purpose. This is what I have explained in the last class. And we have started the quantitative tools. And again, in the quantitative tools, what I told you in the quantitative tools are basically divided into two parts. Quantitative tools Quantitative tools basically divided into two parts. One is policy rates, other is reserve requirements, right? Reserve requirements. Under the reserve requirement, basically CRR and SLR, right? And in the policy rate, main is what? Repos. So repo and other things are also there, but basically it's a repo which is a center focus under the policy rates, and under the reserve requirement there are two, CRR and SLR, and we have started the CRR. And when I started the CRR, good evening Mahesh. So in the CRR, what I told you, CRR must be maintained in cash with RBI. It must be maintained in cash with RBI, right? That means generally what happens. So, like a bank, okay, a bank, and this bank have a branch of network. This is the headquarter of the bank, and bank have network of the branch, right? And if you will see this network, suppose that a particular city, in that particular city, banks have multiple branch, and one branch is known as what? Currency chest branch. Currency chest branch, right? So there is a currency chest branch of every bank, right, in a particular city, right? And then that city is going to have multiple cities, regional branch, right? In that way, then it will go to the headquarter. So generally, how bank is going to maintain the CRR? Bank is going to have a CRR, whatever is their NDTL, right? Whatever is their NDTL on daily basis, NDTL, they have to maintain cash reserve ratio, right? Right now, it is 4.5%. So 4.5% is CRR. Whatever is their NDTL, net demand and time liability, of that they have to maintain 4.5% as a cash reserve. Now, certain questions are there. First of all, why cash have to be maintained? Right. Second question, because this cash have to be maintained in the bank. In the bank, it is going to be maintained in the bank, but with whom? RBI. That means bank have to open an account of Reserve Bank of India in its branch, and in that account they have to show that cash. So physical cash is with the bank, but it is going to be shown in the what? Reserve Bank of India. But the thing is that is in the cash, and bank cannot use it for the lending purpose. That means, suppose if bank have taken 100 rupees as a deposit from whom? Bull bear trap. Good evening, good evening. So if they have taken 100 rupees as a cash out, sorry, 100 rupees as a deposit, bank has taken NDTL 100 rupees as a deposit, so 4.5 rupees they have to maintain in cash. So any deposit you have taken, that means bank have to pay the interest on that money, but out of that money certain money should be maintained in the cash. So that is why banks are not interested to have CRR. They are never interested to have CRR, but RBI enforced them कि you should maintain the cash reserves, because when the bank are involved in the transactions, lending and depositing, maybe because of certain circumstances. Suppose that there is a rumor in the market that bank is facing a lot of issues. Suppose this rumor is going to circulated in the market that bank is facing this issue, and maybe bank is going to what collapse. Then certain customer will go to the bank and they'll say that no, I want to withdraw that money. But if bank is not maintaining any cash, right, if bank is not maintaining any cash, then bank is going to say that right now we are not able to cater your requirement. Then the person who went to the bank with that kind of a rumor in his mind कि bank is going to be bankrupt. When bank is going to say that कि we do not have cash right now, then that rumor they will feel that कि no, it's not a rumor, that is reality. Then entire banking system going to be in the panic, right? So this is why, because you are involved in the lending and depositing business, so you must maintain certain cash in reserves. But the problem with the cash is if you are going to have a cash, that means you have to pay interest. That part of money means 100 rupees bank have to pay the interest. So out of that 4.5 have to maintain in cash. So in that cash bank have to pay the interest from its pocket. That is why bank is not interested to maintain that cash reserves. This is the simple reason. And if you will compare the cash reserve requirements in India, all over the world banks have to maintain cash reserve. But if you will compare cash reserve in India with any other economy, not with the recent crisis, but if you will see overall cash reserve requirements enforced by the central bank on the banks in their banking system, you will find that India means RBI is going to put highest cash reserve requirement on their banks in comparison to any other top economies like of G20, right? So RBI very strictly push this thing of cash reserve requirements on its bank, right? So banks many times they say that this is little bit harsh. So in order to compensate, what RBI said that okay, we will give you some leverage. Leverage means okay, fine, you should not worry about that. We are going to create a window for you so that you can utilize. What RBI told bank, okay, fine, the CRR requirements you have to maintain. We are not going to abolish it. You must have to maintain CRR. But in CRR, we are going to give you kind of window. Right now, you have now from here, listen very carefully, okay? So the cash reserve requirement you can maintain on daily basis and on fortnightly basis, 14-day. So bank said that we didn't get that. RBI said, okay, if you didn't get that, I'll explain you again. You have to maintain on daily basis as well as fortnightly basis. Now, what it means that? It means that suppose on day one. So on day one, bank's deposit is 100 rupees and bank have to maintain 4.5 rupees as what? CRR. So RBI said that from day 1 to day 13, you can maintain 80% of CRR requirements. From first day to 13th day, you can maintain only 80%, for example, right? 80% of CRR. But on 14th day, you have to maintain 100% of CRR. What it means? It means on day one, what is NDTL? 100. NDTL is 100. How much CRR? 4.5%, that is 4.5 rupees. But you need not to maintain 4.5 rupees. You have to maintain only 80% of that. Only 80% of that. That means 3 rupees 60 paisa bank have to maintain. I hope I'm right. 3 rupees 60 paisa bank have to maintain, right, of the CRR. That means rest of 90 paisa. Rest of 90 paise is free. Bank can invest. Bank can invest. Right. Similarly, suppose on day two, banks NDTL went to 200. Banks NDTL went to how much? 200. That means cash reserve requirement is going to be 9. But bank need not to maintain how much? 9. Bank can maintain how much? Bank can maintain only how much? Bank can maintain here only 9 rupees. 9 rupees ka 80%. How much? 6 rupees 20 paisa you have to maintain. Rest of the money 1 rupees 80 paisa is free. So similarly, you can do this thing on daily basis. You can do this thing on daily basis. But once the 14th day will come, suppose that on that day bank have NDTL of how much? Bank have NDTL of 400 rupees. If bank have NDTL of 400 rupees on that day, then how much? 4.5% of this. 4%, 4.5% of this you have to maintain. Complete amount will be how much? 18 rupees. So full 18 rupees you have to maintain on that day. From first day 80% of CRR, second day 80% of CRR, third day 18% of CRR, but on 14th day you have to maintain complete amount of CRR according to your NDTL, right? So in that way, banks are going to get some small window of the CRR is going to free for them. Some part of CRR, the cash reserve is going to free for them so that they can use that money and they can utilize that money for the purpose of lending and making some interest, right? So this is the thing banks are getting from whom? Reserve Bank. But remember that I have given you the example of 80%, right? So this 80%, I have given you the example of 80%, but it is again complete wish of, means completely depend upon whom? Reserve Bank of India. Reserve Bank of India, if want, they can make it to 99%. If they want, they can make it to 50%. So that is completely depend upon the Reserve Bank of India ki how much window it is providing you, right? So how much window it is going to provide you? If RBI is going to make it 70% only, that means more money is going to be available with the bank for the purpose of short term lending. If RBI is going to make it how much? If RBI is going to make it from 80%, if RBI is going to make it 99%, so the bank's availability of liquidity is going to what? Decrease, right? It is going to what? Decrease. But if bank RBI is going to make it how much? 50%. That means the liquidity availability with the bank for short term lending, it is going to what? Increase. So in general, when RBI under the monetary policy is going to take action, so generally they do not change reserve requirement, like it was 4%. So generally they do not change the reserve requirements from 4%. What they change from the daily requirements. So it was 4% earlier, they was allowing 80%, maybe they are going to reduce it and they will push the banks to maintain how much? 90%. So in this way, the cash reserve requirements generally change. But when RBI is going to increase this, the percentage, it is showing that the time has come, situation arrived when RBI have to step in such a way so that it can absorb good amount of liquidity on very immediate basis. A good amount of liquidity must be absorbed at very immediate basis. That is why whenever the CRR is going to be changed, see, repo rate, reverse repo rate, they are going to change. They are going to change. But if you will see when RBI has changed the CRR requirements, so CRR requirement change means that there is a kind of tectonic shift from the policy which RBI is following since last few quarters. So if earlier it was 4%, now RBI has increased to 4.5%. Why? Because even with the 4%, It was 80%, sometimes 70% you have to maintain, sometimes 90% you have to maintain. So RBI using this thing, when RBI feel that less liquidity should be available, they will make it to 90%. RBI feel that more amount of liquidity should be available, they will make it to 70%. So they are not changing this CRR percentage. But if they are changing the CRR percentage also, this is showing that yes, the situation is not good in terms of it is going to increase. It is going to increase 4 to 4.5%. That means it's a very serious issue, and RBI is feeling that the other measures are not working. That's why we have to go for what? Increasing CRR itself. Similarly, if RBI is going to decrease the CRR, this is also going to show a very good measure, like कि economy is growing very good way, inflation is under complete control, and each and everything is going very good manner. That's why RBI has decreased the CRR requirements. So CRR requirements are a kind of what? It's a kind of indicator of major tectonic change in the monetary policy system. Got it? In case of emergency, bank have to maintain cash reserve ratio so that meet that public requirement. Yes. So I hope you got the purpose of the CRR and why CRR is very important, right? So change in the CRR is going to make nervous. When RBI changed that CRR, it makes nervous all the financial institutions, all those people who are investing their money in the Indian economy, right? They will become nervous. Why? Right? Like it's like you directly went to the principal's room, right? Teacher and generally student have any issue, they will talk to their colleagues, they will talk to their class teacher, then other teacher. If somebody is going to directly go into the principal room, that means it's a severe thing. Principal is calling you, not class teacher is calling, not the maths teacher is calling, directly principal is calling. That means issue is severe, right? So similarly, when RBI is going to make changes in CRR, that is going to give a kind of indication that now situation is what? Situation is severe and we have to take care of in the more rigorous manner. One thing. Now, from here, as I explained you, banks have this from first day to 13th day, first day to 13th day, they can maintain certain percentage of CRR. Maybe 80%, maybe 90% or 70%. But on 14th day, they have to maintain how much? They have to maintain 100% of CRR, right? So sometimes what happened, because that should be maintained on their daily NDTL. Whatever the NDTL they do have on daily basis, of that they have to maintain CRR. And NDTL is a kind of thing which is keep changing. So sometimes what happen when they have to maintain that CRR on their 14th day? Sometimes what happen ki bank may be missing some liquidity for that particular day. Bank may be missing certain liquidity. For example, their NDTL is somewhere around 400 rupees and they have to maintain how much? 18 rupees as what? 18 rupees they have to maintain as a cash reserve 100% because it's a 14 day. But bank is short by, suppose that bank is having 17 rupees 20 paisa, bank is short of 80 paise. So how bank fulfill those requirements? So classically in 1950s and 60s when this system was working there itself, then at that point of time when bank feel that ki tomorrow is my 14th day and maybe I am going to miss certain amount of liquidity, so they call other banks and they'll ask ki, okay, please try to understand, we have a requirement of somewhere around 80 paisa for one day. If you will lend me that money, I'll pay you the interest. So bank over the phone, they call other bank and they request for 1 day lending of certain amount so that they can fulfill their cash reserve requirements. So over the phone call, certain banks are requesting for what? Getting the money, and other banks who have surplus liquidity, they are going to give that money. So this CRR system allowed a new kind of short term lending market. Why I'm calling it as a market? Because in market means what? Market is a place where buyer and seller are there. Buyer and seller are there. So here there are certain banks who need money, right? They need money. They are considered as a buyer, where there are certain banks who have some surplus and they will provide that money in the form of lending and they consider as a seller. So in that way, a kind of market came into the existence, and that market is working over the phone call, right? So the interest rates offered by the bank is known as call rate. Call rate. And the money offered under that interest rate is known as call money, right? So what is call rate? Call rate is the rate of interest charged by one bank over other bank in order to provide money so that the borrower bank fulfill their immediate cash reserve requirements which they have under this system. That is call rate. And the money borrowed by the bank is known as call money. So it is the interest rate for a day. Money borrowed for a day. So this is what? This is call rate, right? This is call rate, okay? And call money, right? So this is for a single day, but sometimes liquidity is going to be what? Liquidity is going to fluctuate. So sometimes bank need more money, not for just 1 day. They maybe need for 2 days or 3 days, or even for up to how much? 14 days, right? 14 days. Then if you are lending, if you are a bank and you are lending a money for more than 1 day, right, in order to fulfill your CRR requirements, you are borrowing more money, means you are borrowing money for more than 1 day, up to 14 days, up to 14 days, right? Then this rate, which is for more than 1 day but up to 14 day, it will be known as notice rate, and the money which is borrowed is going to be known as notice money. Now question is, sir, why 14 days? So like economy is divided into quarters, right? First quarter, second quarter, third quarter, fourth quarter. So similarly in the banking system, there is a system of 14-day cycle. So 14th day cycle, now there is no 15th day. After 14th day, the next day is what? The first day, right? The first day. So there is no such a kind of the thing as a 15th day in the CRR system. First day, second day, third, fourth, fifth, sixth, seventh, eighth, ninth, 10, 11, 12, 13, 14th. So 14th day, suppose that bank, today is 13th of August, right? Today is 13th of August, and suppose today SBI is having 14th day. This is SBI's 14th day. So they have to show the complete CRR amount in their ledger. In their ledger, it must be 14th day, and full amount of CRR of their NDTL must be mentioned there. Otherwise, they will be penalized by the Reserve Bank of India. So in order to fulfill that requirement, maybe State Bank of India has borrowed some money from Bank of Baroda today, and tomorrow it is going to return. Right, tomorrow it is going to, but tomorrow is a holiday, Sunday is there. right? Sunday is there, so automatically next working day, that is going to be 16th. So 16th of August is going to be the another first day of the bank. So in that way the 14-day cycle will run. Understood? Sir, CRI is controlled for the inflation or any other reasons? I'll answer this question, but first answer my question. What I explained you till then now, is it clear or not? Any doubt? I'll answer your question. BBT is asking, sir, what about last 15 days? I told you na, there is no such 15th day. Only 14th day is there. So it cycle go, it's in a cycle. 14-day cycle is there. So there is nothing like a 15th day. 14th day is a judgment day. राइट, इट्स अ जजमेंट डे, कयामत का दिन। उस दिन पूरी कायनात खत्म हो जाएगी, फिर से पहला दिन शुरू हो जाएगा, फिर से कायनात जो है दोबारा से आएगी, राइट? तो इट्स लाइक दैट, देयर इज नथिंग लाइक 15th डे। अच्छा, ओके, नाउ सी, I told you this CRR, actually the CRR is not a kind of a primary tool used for the purpose of monetary policy. Like in Hindu mythology, there is a Brahmastra, right? So CRR is a kind of Brahmastra kind of the thing. When the other things are not going to work, or you want to make big impact in all of sudden, then you are going to use this CRR kind of the thing. So technically speaking, very technically speaking, though CRR is an instrument of monetary policy, agreed, but the main purpose of CRR is what? Is to manage this market where short term lending and depositing is happening, and this market is basically the part of money market. So there is a money market. In that money market, for short term lending and depositing is happening on the basis of CRR requirement, and what is call rate and notice rate, right? So call rate and notice rate, call money and notice money, right? So it is call money market. So market, or in other word, financial market, right? Financial market basically divided into two parts. One is money market and other is capital market. Just for basic understanding as of right now, this market is for what? Long term requirement. This market is for working capital requirement or short term requirement. So for short term requirement, there is a money market, and in that money market, there is one known as call money market. So there is a call money market, right? So call money market is a part of money market, right? Money market is regulated by the Reserve Bank of India. Okay, there is a call money market, and this call money market is a part of money market, and the money market in India is regulated by the Reserve Bank of India. Okay, now try to understand in the broader way. In the broader way, try to understand. See, when India got independence on 15th of August 1947, from that day till the 1990s, India was a kind of a closed economy where government do regulate the economic activity through their own companies, right? So the role of money market, the role of call money market was very limited because there is very limited private participation. Okay, there is very limited private participation. But when economy opened for private sector will come. Private sector do not have a kind of facility like all the government companies have. What government companies have? Government companies, for example, BSNL. So BSNL, from 2008 onwards, the company is not able to make any profit. They are consistently in the loss. But again, government has announced the package to revive the BSNL. Why? If you want, I'll answer separately, not in this session. But government try to revive. So company like BSNL, right? So they need not to worry about the financing, right? Because government is always available there to finance them. But like Vodafone, right? Vodafone idea kind of a company which they are not able to compete with the Geo, right? And why the Geo is very aggressive? Because they are having a backing of other Reliance companies, right? Other Reliance business is always going to pour the money in order to hostile takeover of the market, right? So BSNL is a kind of always having this ability. Geo is always having an inability of funds from backside. But company like Vodafone, which do not have any kind of the other business in India, they have to survive in this market by this business only, and for that they need a money, right? They need a money, so they have to go to the market. So this is how a private companies need access of this money market, right? So this money market access is going to provide them easy terms and condition loan so that they can run their business. So from 1991, when you have opened your economy for private businesses, you realize that now more active involvement of Reserve Bank of India, more active involvement of Reserve Bank of India is required, so that in this money market, interest rates, interest rate must be stable. Interest rate must be stable. So that is why Indian economy, monetary policy, Indian economy and monetary policy was basically having what? CRR, SLR, and bank rate. But post 1991, many instruments, right? Many instruments, like the instrument of what? The instrument of repo, right? The instrument of market stabilization scheme, instrument of liquidity adjustment facility. All these instruments from last decade of 20th century, the many instrument starting from CRR and other things were started. You know why? The main objective was to stabilize the money market, to stabilize the money market, right? But as Indian economy is right now a kind of mixed economy where private sector dominates, so if any problem is going to happen there, it is directly going to impact whom? Public. And if public is going to get impact, their demand and supply is going to get impact, then entire economy will again in the problem, right? So from 1990 onwards, Reserve Bank of India found that we have to not just take care of our companies, like private companies, government companies, but we have to take care of public also. So the role of inflation become important day by day, day by day. Because if public is facing a lot of inflation related heat, they are not able to make demands properly, then private companies who are involved in the business, they are going to face the problem, and then unemployment, poverty related things will be exist. So this is why over the time Reserve Bank of India feel that through this money market, we have not just control to the money supply for economic growth, but also for inflation, which impact common people, right? So this is how, if you will see the question, Ankit has asked this question, is sir, CRR is controlled for the inflation or any other reason? So basically, inflation is the main thing. Inflation is the main thing, but this CRR is not going to be frequently used, right? It is not going to be frequently used. Basically, CRR requirements is used for the purpose of controlling the money market. Why money market? Because you have to control the interest rates, right? And interest rates fluctuates according to the inflation in the economy. So indirectly we can say that कि RBI want to control the inflation. In order to control the inflation, RBI have to stabilize the interest rate, and for stabilizing the interest rate, you means RBI uses the CRR, right? I hope you got this question. From 14, from 14 next day will be contest. After 14 day, there is no 15th day. There is the first working day. So these are the 14 working days, and after 14th working day, there is a first working day for CRR requirements. So I hope this CRR thing is clear. Okay. So from CRR, let's move towards SLR. All scheduled commercial banks have to maintain certain amount of their total deposit in detail in terms of cash or gold or government securities with themselves is known as SLR, statutory liquidity requirements. PYQ सेशन भी होंगे. What happens if the repo rate increase or decrease? I'm not going to discuss the repo rate right now. I'll discuss first this SLR, then I'll go for repos, then I'll answer your question. As of right now, focus what is SLR and how it's work and how it's impact in the monetary policy. Okay. And PYQ, for PYQ, there is no time for the PYQ discussion, right? Just go through that. If you have any doubt, let me know. Means I'm not able to take the PYQ session because we have very limited amount of time. So SLR. So I have just explained here, mentioned that key all scheduled commercial banks have to maintain of their NDTL in terms of cash, gold, or government securities, right? Either cash or gold or government securities in the form of cash, gold, or government securities. That is known as what? SLR. So what is the basic difference between CRR and SLR? First, basic difference, because some students are asking about that in the last class. So first basic difference, CRR have to maintain with RBI, whereas SLR have to maintain with bank itself. Number one. Number two is SLR can be maintained in either in cash or in gold or in government securities. We call government securities in short GSES, right? Government securities, GSES. Whereas in this case, it have to be maintained in the form of what? It have to be maintained in the form of cash. right? It have to be maintained in the form of cash only, right? So this is the basic difference. However, the rest of the thing we will discuss later. What is the difference in CRR and SLR? Now, SLR of the NDTL of the bank, right? Either cash, gold, or government securities, and with themselves. So, suppose there is a bank, and this bank got NDTL of how much? NDTL of 100 rupees. So, of this 100 rupees, they have to put 4.5% cash, right? In what? CRR, whereas 18 rupees they can maintain in cash, gold, or government securities. Now, because bank already have cash of 4.5 rupees mandatorily, this is 100 rupees bank has received in terms of deposit, on which bank have to pay the interest, and of that 4.5 there is a force on the means by the statutory law they have to maintain that thing in the cash, means bank is not going to get anything on this CRR, right? Whereas here the option is either cash or gold or government securities. So definitely bank is not going to maintain this thing in the cash, because cash will be remain same. There will be no change in the assets value of that 18 rupees even after certain days. So bank is definitely not going to maintain in the cash. Now the option with the bank is what? Gold or government securities. They can go for gold, right? They can go for the gold, but gold prices are fluctuating in the market. So maybe at the time of maturity of this money, if the gold price is going to decrease, then bank is going to have a loss. So again, gold is okay, good option for the longer term, but in the shorter term, gold is not a good option. So what left? Government securities. What is government securities? First, understand what is security. It's a written promise, right? Written promise to pay. A written promise to pay. Okay, I'm promising you that I will repay the money, right? So in that terms it is called security. Now if we will prefix here government securities, that means government is issuing a paper, and on that paper government is promising that we will repay the money what we are getting against this paper. So the paper issued by whom? The paper issued by, now listen very carefully from here, paper issued by RBI on the behalf of Government of India. Paper issued by RBI on the behalf of Government of India for the purpose of lending, right, is known as GSES, that is government securities. Is known as what? It is known as government securities. Now this GSES, that is government securities, is of two types: long term, short term. From 1 year to up to 40 years. Short term from 91 days to up to 364 days. So this paper in India, it is defined as Treasury Bills, and it is known as government bond, right? Government bond, and this is known as Treasury Bill. Whereas if you are referring sources like Investopedia, they will not mention it's what? Government bond or treasury bills. They are going to mention it's as a treasury bonds. So any paper which is issued by the Federal Reserve on the behalf of US government in order to borrow money for the US government, that is known as treasury bond. It may be of 91 days up to 40 years, right? So there is no classification in that way कि treasury bills are up to 364 days and bonds are from 1 year to up to 40 years. There is no kind of the classification in the US system. Treasury bond means a paper issued by the central bank, that is Federal Reserve, in order to borrow the money for the government, right? In India, this is the treasury bill and this is the government bond, right? अरे काके क्यों जंप करता है आगे आगे? जो पढ़ा रहा हूं पहले वो तो समझ ले। अब मैं ट्रेजरी टी-बिल समझा रहा हूं, तुम्हें जीरो कूपन बॉन्ड पे जंप करना है, ठीक है? पेशेंस रखो, हैव अ पेशेंस, लर्निंग नीड पेशेंस, ठीक है? लर्निंग नीड पेशेंस. इफ यू आर नॉट हैविंग दिस पेशेंस, यू आर गोइंग टू मैश अप इन द क्वेश्चन पेपर, ठीक है? ट्राइड इकोनॉमिक्स है माय डियर, इकोनॉमिक्स नीड सम पेशेंस, राइट? It needs some patience. You have to learn the things in the layer, not as slices. Layer. Fine. You have to learn the things in the layer, and learning takes some time. Zero coupon bond, I'll explain when the bond I'm going to explain. Zero coupon bond is not need to be explained here. It is going to be in the completely wrong direction. Right. So I'm not going to entertain this thing. I made it thing very clear. Right. I have a way of teaching, and I'm not going to change the way of teaching because of anyone. I'm not going to change. Yes, if you are not able to understand what I'm explaining, let me know. I'm ready to change the methodology of the teaching for that particular thing. I'm always ready. I do not have any issue. But the fundamental way, I'm not going to change. I will not jump there until unless it is desired. Until unless this is desired. For example, here I have explained you about what? Here I explained you about money market instrument, because until unless you are not able to understand that instrument, your understanding about the CRR is going to be what? Half baked. You will never understand, right? And you can go through other things also if you want. They are not going to explain the CRR in such an extensive way. That is why sometimes students, despite knowing that CRR, they remain confused. They remain confused ki what is the purpose of the CRR. If the CRR is there, why RBI is not changing CRR frequently? That they are changing the repo rate and reverse repo rate. I asked this question in many interviews when I have taken the interview, mock interview. I asked this question even to the civil services aspirant. I take the mock interview of the civil services aspirants. I take the mock interview of NABARD, SEBI, RBI, all them. And whenever I ask this question, why it is not being used frequently, people do not have a kind of conceptual answer. They try to give lot of things, but they are not even able to make the concrete thing why CRR is not frequently used. So for that, you need a proper learning, right? So my dear, I am very particular about that, right? Maybe I have a means you and me on not some same page for this thing, but I will go with this way only. Okay. So treasury bills, right? What is treasury bill? Short term instrument used for borrowing by government through whom? RBI. Now question arises, why with the RBI? Why government do not do this thing on its own? The thing is, if government want, government do that thing on its own. But the problem is, if you are going to do this thing on your own, you will be on the same page what British India government was doing at that point of time before inception of the Reserve Bank of India. The main reason for the inception of the Reserve Bank of India was that only. Because government was not able to manage it properly. How much money we have to borrow? If you are going to borrow unnecessarily, because if there is no institution to stop you, you are the person who is going to issue that paper and you are the person who is going to borrow that money from the market. You can borrow the unlimited money. Then maybe a huge mismanagement in the economy, right? And this is the way when the economy is going to fail. What happened in the Sri Lanka? What is happening in the Pakistan? Their government have unnecessary over influence over their central banking, right? So their central bank not as free as central bank in India, right? So that is why the Rajpakshas in where in Sri Lanka, whereas the military and the Pakistani government in the Pakistan, they have unnecessarily pressurized their central bank, and central bank went for the excessive borrowings, and that excessive borrowings is going to what, create an inflationary pressure in the economy. Here RBI is going to what, RBI is going to publicly make this thing to the government, no, this is the excessive borrowings, and by this borrowing it is very difficult to manage, it is very difficult to manage that borrowings. So this is why generally government know that ki maybe I am not able to take a right decision in the context of ki how much money we have to manage, right? This is the amount of money we have to manage, right? So who is going to tell? RBI. So this is why generally central banks are there all over the world, and where the central banks do not have an autonomy, proper autonomy, economic system is very vulnerable. Economic system is very vulnerable because central bank need autonomy. One exception is China. Chinese economy is growing in such a good manner because of dictatorship. But again, they are having the same vulnerability. Same vulnerability. China is not allowing to open all those things. They are having a big crisis right now. Their real estate sector, which is backed by the Chinese government, is facing a kind of severe crisis. Severe crisis they are facing right now. Their real estate sector, which is backed by the Chinese government, right? But the thing is, because of the censorship, because of many things, political pressure, right? And Chinese are very tight-lipped, because if something will come out that is going to damage the image of China, so Chinese government is going to restrict all those things. Till then this is working, everything is fine, but the day it is going to collapse, it is going to collapse in the biggest manner. This is why we want a kind of a political system where the democracy is there, so that central bank can work in the proper manner, right? So this is why we do have what, we do have RBI in India, Federal Reserve in US, Bank of England in what, England, right? Central banks. So central banks issue the government securities as per the requirement of the government. If government is want more borrowing, then central bank tell this thing ki excessive borrowing is going to create a problem for you, so that way it is going to be managed, right? So that government securities is going to be issued. So now, as we are discussing the SLR part, now bank have option to go for cash or gold or government securities, right? Go for cash, gold, or government securities, right? So bank need government securities. Bank need government securities in order to fulfill what? Now please focus here, huh? Then you will understand the entire way how the economy run. How the economy run, how government get low interest rate money. If you will see, government is getting very cheap money in the sense that government is getting the money on very low interest rate, whereas the other private players, they have to borrow the money higher interest rate in comparison to the government. See how, as I told you, banks have to maintain what, banks have to maintain SLR, and for that SLR either they can go for what, either they can go for cash, they can go for what, they can go for cash, or they can go for gold, or they can go for what, government securities. But they will prefer what, government securities, because the money you are going to use for the purpose of purchasing of what, government securities, it is issued by whom, RBI, on behalf of whom, government of India. Means whatever the money you are going to invest here, that 18 rupees you are going to invest here in the Jesus, that is having no issue with respect to security. Your money is going to come back to you with interest, that is 100% guaranteed, because it is going to promise made by whom, government. So that is secured investment, number one. Number two, if you will go for the gold or cash, there is vulnerability. So banks are preferring to go for this SLR investment in what, SLR investment in the government securities. So banks will lined up, Banks will land up to get what? Government securities, right? So suppose that there is an agreement between Government of India, like, understand in this manner. Government of India need 100 rupees. Okay, Government of India need 100 rupees, and for that Government of India said that to Reserve Bank of India कि we need 100 rupees and please provide that. Reserve Bank of India said that कि money will be available but you have to pay 6% or 7% interest. That means at the end of the tenure you have to pay how much? 107 rupees. Government said okay. Government said okay. Now Reserve Bank of India made a paper on the behalf of Government of India, and RBI has mentioned, listen very carefully, huh? RBI has mentioned this paper is having the worth of how much? This paper is having the worth of 107 rupees. 13th August 2022. Maturity period of this paper, suppose that, just for your understanding, huh? 1 year. After 1 year, RBI promised to repay how much? On 13th August 2023, RBI promised to repay how much? 107. What is the face value? 107. 107 is the face value. Okay. 107 is face value. What is maturity value? Maturity value is how much? Maturity value is 107. So face value and maturity value is same. Is anyone who is going to purchase at 107 rupees? No, because after 1 year you are going to get 107. Why I'll purchase? Nobody will purchase. Then RBI said that, see, this is the government securities, but I am going to offer discount of 7 rupees. I am going to offer discount of 7 rupees on this security. So RBI went to the market where banks are assembled to purchase government securities, and RBI said that this is the government securities of having maturity value of 107, face value of 107. I am going to provide you on the discount of how much? 7. So actually, how much you have to pay in order to purchase? 100. 100 you are going to pay, and you are going to get how much? You are going to get 107. So 100 you are going to pay, you are going to get 107. Why? Because RBI is selling this what? This paper on the discount of what? 7 rupees. So this is the paper which is not bearing any interest. If you will see this paper, is this paper is bearing any interest? Is this paper is bearing any interest? No, no. This paper do not bearing any interest. Yes, Mr. BBT. Is this paper bearing any interest? Is this paper is bearing any interest? Answer. Face value is 107. Maturity value is 107. Is this paper is bearing any interest? No. This is clear. What is zero coupon bond? Aniket, I'll answer this question. I'll answer this question, but first understand this thing. So till then, I hope the things are clear. Ki government asked RBI. RBI said that there is an interest. Government said that ki okay, we will pay that money with interest. RBI said okay. So RBI has created a security, that is government security. Face value was given 107 and maturity value was also 107. Then RBI said that I am ready to offer this paper on discount. Discount of how much? 7. Then all the banks, they started saying ki give it to me, give it to me, give it to me, give it to me, because every bank have to maintain their what? SLR, and every bank want to maintain this SLR in terms of what? Government securities. So every bank is demanding ki give it to me. Now RBI have two options. One option is RBI is going to say first come first serve. Those is going to come first, I'll sell this government securities to that one. But rather than going for first come first serve, RBI is going to do what? RBI is going to do a auction. RBI will say that maximum discount is 7 rupees, but I will sell to whom is going for minimum discount. Minimum discount. Maximum discount is how much? 7 rupees. Suppose that SBI said that ki we are ready. SBI is saying that ki maximum discount is 7 rupees, but we are ready to purchase at the discount of 6.80. Just give it this security to discount of what? 6.80. PNB said that हम क्या छोटे बाप के बेटे हैं? We are ready to purchase it 6.70. So in that way, banks are going to participate in the auction of government securities. This is known as auction of government securities, right? So auction is going to be held in such a manner, banks are going to bid for it. 6.80, 6.70, somebody is going to offer 6.40. Suppose that XYZ bank, they are okay with 6.40. The lowest bid went for 6.40. So RBI is going to say that okay, the lowest bid is 6.40 and sold. So if it is sold on the discount of 6.40, so actually how much money RBI has received? RBI has received 100 rupees and 60 paise. What government need? Government need how much? 100 rupees. 60 paisa will go to whom? 60 paise will go to Reserve Bank of India. Right? Reserve Bank of India. So, in the government securities auction, sometimes RBI also going to get the money in this way. So people say that ki, Arey, means RBI is making profits and all. No. RBI is not intended here to make the profit. Number one. Number two, when RBI need money in order to stabilize the thing, then from where RBI is going to get the money? So that is why RBI must have something in terms of their surplus, right? So that is why RBI do this thing, so that some surplus should be with the RBI also. So whenever it is required, RBI can intervene directly with that money, right? So in that way, 106 rupees was collected by the Reserve Bank of India after selling this government securities through auction process, and they have given 100 rupees to whom? Government, right? And banks got what? Banks got that government securities, their SLR requirements, right? Sir, can we buy the T-bills? Yes. Now you are able to buy the T-bills under the scheme initiated by the Reserve Bank of India. I'll discuss this later. Means once I'll finish that part, I'll discuss that thing. There is a retail direct scheme, and under retail direct scheme, you can purchase any kind of government securities, whether it is T-bills or the government bonds. RBI is allowing government of means common people also participate in this market, right? Okay. So in that way, SLR. Now, how the SLR having a capacity to change the complete nature of entire economy. SLRs having a capacity to completely change the nature of the economy itself. How? For example, if RBI in consultation with Government of India decided to make SLR 30%. If SLR is going to be 30%, bank have to maintain 30% SLR. So banks have to maintain 30% SLR. That means banks have to invest huge amount of money in where? Government securities. Banks have to invest huge amount of money in what? Government securities. Government securities are issued for the purpose of what? Government borrowing. Why government want to borrow too much? Government feel that ki private sector is going to exploit. So we do not want the private sector in our economy. We want the most of the economic activity, production activity should be under the control of what? Should be under the control of government run companies. But we cannot directly say that private sector is not allowed. It is going to be challenged. You are being a biased. You are biased against the private sector, right? So government said that we are not biased against the private sector. Private sector want, they can come, they can do the business in India. We do not have any issue. But at the same time, government with the RBI, it's going to what? Is going to maintain 30% of SLR. Now, if bank is getting 100 rupees, okay, 100 rupees and CRR is like 10%, right? SLR is 30%. Right, CRR is 10%, SLR is 30%. That means 10 rupees you have to put in the cash, 30 rupees you have to put in GSES. How much left? 60 rupees. So on this 10 rupees, no income for the bank. Whereas of this 30 rupees, very less amount of income because government securities are going to be auctioned, and auctioned after the auction, the interest rate which you are going to get as a bank, it is very less. So low earning. So this 60 rupees is left with the bank to make good amount of money to be remain in the profit. So bank is going to offer high interest rate, very high interest rate, 15%, 18%, 24%, 28% is going to offer for the private people. Is private people is going to purchase, or they are going to get the loan from the bank? No. If they are going to get the loan on 18% or 24%, their cost is going to be very high. If the cost is going to be high, the product cost is also going to be very high, right? That is why their product are not going to be sold in the market and their business is going to be collapsed. So this is why private people are not interested to do the business in India. So in that way, we have never said to anyone that private sector is not allowed, but we make sure that private sector should not flourish. This was the policy of India from 1947 to 1991. Socialist economy. So 1991 economy was opened, and gradually the requirement, at a point of time India was having 15% of CRR and 45% of SLR. 60% of banks deposit was blocked in CRR and SLR. Right. So after 1991 we opened the economy, and for that purpose we have gradually decreased what? The CRR and SLR requirement. So SLR requirements have two objectives. One is what? It is going to provide the more liquidity, means it is going to provide cheap liquidity to whom? Cheap liquidity to the government, because of government securities are the preferable thing by the banks to maintain their SLR. One thing. Another thing, if government through RBI is going to absorb that liquidity, then the liquidity which is in the system for the private people, common people, it is going to decrease. So whenever you have to increase or decrease the liquidity, please understand here, when RBI want to increase or decrease the liquidity, for whom? For government with respect to the public and common man, public and banking system. At one side there is a government, another side whom? Another side is private sector, banks and other financial institution. Entire economy and other side is the government. When RBI want to shift this balance because RBI want to maintain the inflation. So when RBI feel that ki inflation can be better controlled, listen, if RBI feel that ki inflation can be better controlled if we are going to change this balance, the availability of money for the government, availability of money for private sector, financial institution, common man, if we have to change this balance, then they will use what? SLR, statutory liquidity ratio. So in that way, SLR is used as a monetary policy instrument. Understood? Sir, sovereign gold bonds can consider as a GSS for the SLR. No. Sovereign gold bond scheme for whom? Sovereign gold bond scheme for whom? For whom sovereign gold bond scheme is issued? Answer this question. Mahesh, please answer this question. Public. And who have to maintain this SLR? Who have to maintain this SLR? Public or banks? You got your answer. I have not answered, but I think you got the answer. So SLR is clear? SLR is clear? Okay. So so reserve current rates, CRR and SLR we understood. Now we have to understand policy repo rates, standing deposit facility, margin standing facility, bank rate, and repos. So basically, now we have to understand what is repo, what is MSF, what is LAF, right? What is bank rate? These are the basic things. Standard deposit facility. Also, you have to understand, right? What is standard deposit facility? This part of monetary policy instrument I have explained, right? Is there any limit? Same like CRR. Same like CRR. CRR cycle go for first day to 14 day. Similarly, SLR cycle also run for first day to 14th day. Same manner. First day to 14th day. SLR requirements also run from first day to 14th day. Okay. So this is the PDF. Uh, After this class, I'll send to Ashok sir, right? I'll send to the Ashok sir. He will provide you, right, this PDF, because what I want from you, I'm going to explain this standard deposit facility, but what I want from you, you should read once, right? You should read once. It is going to help you to understand all those things, especially this MSF, and MSS market stabilization scheme. You have to understand, right? So it will be better what if you will read first, then I'll explain, then it is going to help you to grab this thing in the very short span of time. So I'll explain it tomorrow, but right now we still have some time. Is it okay for you now if I'll continue for another 5 to 10 minutes? I hope you do not mind. So this standard deposit facility, the rate at which Reserve Bank of India accept the term, very important term, uncollateralized deposit on overnight basis. Uncollateralized deposit on overnight basis from all LAF participant. Who are the LAF participant? That is next thing. When we'll understand the LAF, I'll explain you. But as of right now, you just understand the few important word in the context of this what? This standard deposit facility overnight basis. The SDF is also financially stable tool in addition to the role of liquidity management. The SDF rate is placed 25 basis point below to the policy rate. These are the different thing. The main important thing first to understand is it was introduced in April 2022. SDF rate replaced the fixed reverse repo rate as the floor rate for LAF corridor. Again, this is not important. What it is important to understand standard deposit facility uh, in this situation. This situation, first you have to understand what is standard deposit facility. Right? Standard deposit facility. Rate at which Reserve Bank of India accept uncollateralized deposit. Uncollateralized deposit. Now, I have explained you the SLR, and in the SLR I told you banks have to park their money in the Reserve Bank of India and they will get what? Government securities. In other words, in order to get government securities to maintain their SLR, in order to maintain their SLR, they need government securities. That's why they have to give this money to whom? That's why they have to give this money to whom? RBI, in order to get the government securities. Right? Okay. Now take this thing in the other way. Other way is what? Means whenever RBI is going to accept any money from the banks, if RBI is going to accept any money from the banks, RBI have to give what? Government securities. RBI have to issue the government securities, right? RBI have to issue the government securities if RBI is going to accept what? Money from whom? Banks. Like in the SLR system, what is happening? RBI is accepting the money from banks and RBI issuing what? RBI is issuing government securities. RBI is issuing the government securities, and against that government securities, RBI is getting the money from the banks. That means every time RBI, when it is going to accept the money from the banks, it have to issue the government securities. Government is saying that ki, I need a loan of how much? I need a loan of how much? 100 rupees. And for that, RBI has issued the government securities. Okay. Government is saying that how much we need? Government is saying that we need a loan of how much? 100 rupees. This is the requirement of GOI, Government of India. And for that, RBI has issued what? GSES. Right. GSES they have issued of worth of 100 rupees. Now, RBI want to RBI want to absorb excess liquidity from system, especially banking system. right? But if RBI is going to get that money from the bank, what RBI have to issue? Government securities. Government securities means money will go to RBI, and from RBI that money will go to whom? Bank. So, sorry, RBI to Government of India. So, Government of India do not need any borrowings. But if RBI is going to issue the government securities, against that government securities, money will go to where? Government of India. How to solve this problem? Government don't need extra money, right? Because if government is, people say that, अरे सर देनो दो ना गवर्नमेंट को थोड़ा पैसा मिल जाएगा, क्या प्रॉब्लम है? Government is not going to hold this money. Once the government is going to get that money, government is going to spend that money, and overspending will, again money will go to where? From government money will go to public, and from public it is going to whom? Bank, right? So unnecessary, the you came back to the money, we came back to banks and public, and inflation is going to rise. So how to solve this excess liquidity problem? So RBI has came up with the solution with what? Standard deposit facility. RBI came with what? Standard deposit facility. RBI said that ki, okay, we are going to allow you. Allow whom? Bank. If bank have certain excess liquidity, if banks have certain excess liquidity, we will accept that liquidity in terms of what? Deposit without issuing any government security against it. So RBI will accept that money, right? RBI will accept that money, and on that money accepted by the Reserve Bank of India, hold by the Reserve Bank of India, and because you are accepting the deposit, RBI have to pay what? RBI have to pay interest rate. Why RBI is paying the interest rate? Because RBI is accepting the deposit, right? RBI is accepting the deposit, and RBI is not issuing any government securities. So government is not liable. Who is liable to pay the interest? Reserve Bank of India, right? So certain section of the students, they are not convinced with me when I told them कि RBI go for auction and RBI made certain money. So they said that ki, sir, it is a kind of what? RBI is misusing its position. It's a government bank. They dictate the things. Yes, they are dictating, but when it is required, they are also helping the banks. No, they have started with standard deposit facility, right? Standard deposit facility. So bank can park their excess liquidity under the standard deposit facility in the RBI, and they can earn the interest. Right. So for that purpose, standard deposit facility was introduced. Right. So it is an innovative way to absorb excess liquidity without issuing a government security. It is an innovative way to absorb the excess liquidity, because any other way, like SLR, repos, under all those, RBI have to issue the government securities. RBI must have to issue the government securities before getting the money from the bank. So the unique thing with the SDF is banks can deposit their money in the RBI without getting any government securities, and they can earn interest. Right? Clear? Again, if you are not having the clarity, no need to worry. As of right now, just have this thing in the mind. What you have to keep in the mind: when RBI accept the money from any financial institution, RBI have to issue the government securities. When RBI accept the money from any financial institutions, RBI have to issue the government securities. Government securities means money will go to government. Government will unnecessarily will get the excess money, and that excess money may cause inflation. So how to stop it? RBI said that okay, we will accept the money, we will hold that money, but we will not issue any government securities. Right? That means money will not go to whom? Government. Money will remain with whom? RBI. And RBI will issue what? RBI will pay the interest rate. This facility is known as standard deposit facility. So this is why they have defined it under standard deposit facility. They have defined it here. The rate at which Reserve Bank of India accept uncollateralized. So more typical kind of what? More typical financial terminology they have used. Uncollateralized. What is collateral? Government securities are collateral. So RBI is accepting the deposit without government securities. So I explained in that way, they have mentioned in that more typical way, because they have written this thing not for the aspirants. They have written this thing for in general economy parlance. What I am doing, I am explaining you for the aspirants who are aspiring for good job, like RBI, NABARD, SEBI, all these things. Right. I hope the standard deposit facility is clear. Sir, but the interest at which RBI is providing may be less than that the bank can make with the investment done by them. So why should they go for this? Acha, maybe bank are going to earn less amount of interest in comparison to what if they are going to invest in other part of the economy. This is what your doubt, right? So, but the interest rate at which RBI is providing may be less than what the bank can make with the investment done by them. So, why should they go for it? Yes, the answer is completely right. But one more thing which you have to focus here, this is for what? Overnight basis. When bank is going to make any investment, it is not an investment for a single day. When bank is going to have an investment, that investment at least going for 3 months, 1 year, 2 year, 3 year, up to 40 years. Here they are talking about what? Excess liquidity on overnight basis. Right. So that overnight liquidity which may hurt the interest rate stability in the market, for that purpose it is introduced. SDF is not like that ki you can park your money for 6 months or 1 year or 10 years. It's not like that. It's not like that. That is for overnight facility. Right. Like in hotel na, you have to check in how they are going to calculate the day, right? They are calculate the day, you have to check in somewhere around 2 p.m in the hotel, and next day at morning you have to check out, right? So that is overnight. So it's an overnight facility, not long term facility. So overnight facility is there. So bank is going to hold that money, right? Bank is going to hold that excess liquidity, and if they are not going to park for overnight, they have to pay the interest. Suppose that I and you have deposited that money, and bank is feeling that ki I have this excess liquidity. Suppose you and I, all of you, we have deposited that money in the bank for temporary purpose. So for temporary purpose, if bank is feeling that ki I have an excess liquidity and on which I have to pay the interest, right? Then bank will do what? Bank will increase the interest rate on other things to compensate for this, right? So this is going to increase the interest rate in general. Why? Because bank have excess liquidity on overnight basis. Bank have to pay the interest rate on that to the public. So in order to compensate that short term liquidity, excess liquidity, they have increased their interest rate on other things. RBI said no, don't do this thing, park that excess liquidity to us, we will give you the interest. So in that way, banks have stabilized the interest rate in general. So this is the purpose. Got it? Clear? Okay. So as I told you, I have explained this standard deposit facility also. I'll request you please read that PDF After this class, immediately I'm going to email this PDF to Ashok sir. He will share with you, right? Once you will get the PDF, please read that so that we can wind up this monetary policy part in next half an hour when we will start tomorrow, right? We will have a class tomorrow also. Tomorrow I'll explain this thing in the detail. Maybe on 15th I'm not going to take the class. Maybe I have a plan to take the class, but maybe if I'm not going to take the class tomorrow, I mean day after tomorrow on 15th, so what I'll do, I'll extend that session, or if required I'll take two sessions tomorrow. 1.5 hour, 1.5 hour, two sessions with some break. I'll take the two sessions. But what is my in my mind? First, I'll finish this part, monetary policy part. Then I'll also explain you the money market, how the money market works, because explaining the money market and explaining this monetary policy, it is means most of the things they are going to overlap in both those part, so it will be good for you, right? So please read that part so that we can finish this part in half an hour, then we will start the other thing. I'll ask Ashok sir. He will share on the Telegram. Okay. So winding up this session right now. I hope this session was uh, kind of you have gained few things. So start tomorrow, and we will wind up this session. Now I'm winding this session. See you tomorrow. Okay. Thank you.